This is another episode of me documenting the day-to-day process that I'm taking to achieve long-term consistency in the financial market. And today is a red day to start out the month of September 2025. But it literally does not matter. I'm getting to the point where I have a red day and it literally means nothing. Because I know all I do is I come to the next trading day and do the same thing over again. That's it. Nothing changes. Come to the next trading day, do the same damn thing, apply the same model, and get a different result. That's how it works. And that's how it's been working. That is how profitable trading is. Eventually get to the point where you realize that losing does not mean anything. Because you can come to the market the next day and have everything that you could possibly want and take a solid setup. So I'm not bothered by it at all, although there are some big changes that I made that could affect my performance in the near term. And in the near term, I expect to incur some drawdown because I changed my model. I changed my entry model. The way that I got into a trade last month, I felt was way too loose because there was way too many trades where I was having impulsive or early entries. If we go to my reports, if we look at last month, and if we go to tags, we can see that most of the damage done last month was because I either took an impulsive trade or had an early entry. So I took a step back and realized that my way of getting into a trade is very loose. It's not really defined at all. Some of you guys in the comments mentioned this. So I made an effort to just focus on one thing that makes the most sense to me, and I think that is trading order blocks. I like order blocks the most. They make the most sense to me. You can easily frame the risk off of them, and they deliver. They deliver very well. So in my monthly review at the end of last month, go to the session recap. A couple of things I'm going to trade this month. After doing my monthly review, I came to the conclusion that I'm going to eliminate my current entry model. The interval entry mechanism that I've kind of made up, kind of codified my own thing, it's not really working out for me so well because I'm getting into so many trades impulsively. So I decided to create my own thing, which is where I'm just going to focus on one mode of getting into a trade, and that's going to be the change in the state of delivery, and I'm just going to stick to ICT fundamentals. Now my face was in the way the entire time. Might have to redo this video. Let's see. Okay, not really. I'm just going to put myself in the bottom left. So that's usually where I'm out of the way. Perfect. All right, now let's get into today. So view my day. So the net P&L today is $149.94. So I'm back at basically break even on the top step eval. Now, if we look at my overall performance, we can see that for the past 3 months, I'm basically a break-even trader. So I'm in the stage of break-even, trying to find my way out of it. I'm just tightening things down. I'm just dialing things in more and more and more, getting more restrictive, I guess you could say, with the things that I'm looking for, which is why I eliminated my old entry model. Now I'm just looking for one thing to change in the state of delivery. So I'm going to execute that and obvious gaps, and that's basically it. That's all I want to do. But if we go back to today, you can see how I felt about today. So I was pretty confident that everything in the chart was telling me the price should reach for the old daily low on the daily chart, and beyond that, the smooth sell side resting below the consolidation range. So what I was looking for was this old daily low. Now I was so confident in the idea of lower prices today that I literally completely forgot to annotate what I was looking for pre-market. So if we go to other days, let's go to Friday, for example. I have annotations and recorded screenshots of the market before it opened at 9:30. Today, I literally forgot to do that. I think that's how confident I was in the idea of the market going lower. And so my bias was the long-term low from the Powell event was manipulation and manually repricing the market to the daily sell-side imbalance, buy-side efficiency, and changing the state of delivery. Now price has confirmed a reaction to that level and created another reaction off the change in the state of delivery in the overnight session. So it's very heavy and going to create a 300 handle discount gap opening, which is likely not to get filled as price seeks to complete this sell model. Reaching the old daily low, I think it's clear the high week may potentially be in. So we had a huge impulse swing in the overnight session, confirming the market is bearish following Friday's close. We now have 2 consecutive large down days. So the draw on liquidity for me was that old daily low on the daily time frame. Pull up the chart real quick. This was the low that I was aiming for. So I was anticipating another large down day today to deliver the old daily low. That was the draw on liquidity I established in my pre-market plan. As you can see right here, old daily low, right? So for me to get on side, I would like to see the algorithm offer fair value at the open. Obvious gap located in a premium. I would like the market to offer that to continue to go lower. Now how it's setting up with little sell side created. It could be bullish in the opening range or it could stay heavy and just leave. Watch the first 5 minute range and see how price reacts to discount gap opening. So I was looking for my bearish discount gap opening setup where the market gaps down from where we settled yesterday. If you toggle regular trading hours, we can see that we had a gap down opening. So I was anticipating the market to trade up, fail to close that gap, and then trade lower like this. Now my problem with my executions today where they were just simply at the wrong location in price. Not only that, but I had the market approach entirely wrong because new information shifted once the market delivered my draw on liquidity. We can see that the first thing price did at 9:30 was drop down, take the pre-market low with the low of day, deliver the draw on liquidity that I mentioned in my pre-market plan. And then from there, new information suggests that the market should not go lower than the low of the old daily low. Although it did come back there, but only after the market offered a premium of this impulse swing. And that's how I struggled to get on side with this move today, because I was too busy selling short way deep down in a discount, impulsively executing on the new entry model that I've created, which is why I'm kind of thinking that as I establish this new entry model, I'm probably going to go into some drawdown, because anytime you make a change, you automatically take a 20% reduction in your performance because you have to get used to that change. So in order for that change to make sense, it has to yield a over 20% positive change, a potential positive change of over 20% to improve your performance. Because anytime you change something, you're automatically going to take a 20% cut on your performance. Now, right now, I have to get used to entering off just the change in the state of delivery. So automatically, like that, I'm taking a 20% cut in my performance, and that was reflected today in my entries. They were very, very sudden. They were very quick, and they were both at the market. So from doing the monthly review last month, I came to the conclusion that I should not be entering at the market at all, but I did so in 2 trades that I took today. I should never be executing at the market. I should always be using limit orders. But both of the trades that I took today were at the market because of that new entry model that I've established, which is changing the state delivery. Now, aside from that, I was executing in the wrong location. So let's pull up the top step executions today. Okay. So the first loss that I took, I was considering the idea of the market reversing out of this gap right here, annotated in red. Now the issue with this is that it's way deep down in the discount, right? And the market didn't actually reverse until it reached a premium of the impulse swing lower. So I didn't have to be right about the direction of the daily candle, although my overall bias was incorrect, because as soon as the market delivered that old daily low, new information changed, and it made no sense to see the market want to go lower. It still did so, but only after it delivered a premium, only after it delivered this gap right here. So it's a rather simple lesson about the location of my trades. If I'm looking to get on side with the move, my short should be in a premium, right? There are some cases where the market stays heavy like it did on Friday and it just keeps going. It just keeps going. But in order for that to happen, I need confirmation from the 5 minute that tells me the market is going to do that. That's why I said in my pre-market plan, go back to the pre-market plan, it could stay heavy and just leave. I have to watch the first 5 minute range and see how price reacts to the discount gap opening. So what confirmed that the market was very bearish on Friday was the fact that it just instantly rejected the discount gap opening. Let's go to Friday real quick. We can differentiate between the market leaving right at, this is August, wait, 2022. I've been backtesting 2022, that's why I went to 2022. So we can see that we kind of opened off of the low day with smooth sell side below. And the first thing that price did, here's this 1 minute chart. First thing that it did was trade up. It rejected that discount gap opening, could not even trade to a quarter of that gap. And then the 5 minute stayed heavy over the low of day, which was an indication of continuation beyond that low. Today, that's not the case, right? Today, that is not true. We do not see that close below the low of day. It does not indicate continuation. It closes back inside the range, and then we see this strong push back into a premium. Then we get that break lower. So because the market did this, I'm not looking for a continuation at the open. So I'm watching how price is respecting that gap on the 15-minute. Remember, this is a 15-minute SIBI. I'm noting how it traded up into it here, but closed below it. And then the following candle did the same thing, traded up into it here, but closed below it. So for my old entry mechanism that I used to use, I would anticipate a drive above this candle's high to fail. So I'm anticipating a drive above that candle's high to fail because how those 5-minute candles close within this gap tell me that it's respecting it. It's a sign of weakness. So the market drives above that high, and I'm anticipating a drive above to fail because of weakness indicated on the 5-minute. Large down the candle comes in, and I sell short at the market once we have a change in the state of delivery on the 1-minute time frame. So I'm really learning the difference between what makes an order block and what does not make an order block. If order block is the one PD array that I'm going to be using for my executions, I have to know everything about it. And I've come to the conclusion by studying all my back-tested executions that I have collected so far that this is what makes a high probability order block. So what makes an order block? Just writing these notes down. There's nothing final here, but this is just the conclusion that I'm coming to. So an order block must remove liquidity from the marketplace, and it must reference a PD array and indicate respect of it. It is not just the overlap of a down candle when bullish or up candle when bearish. It has to remove liquidity from the marketplace or refer to a PD array, because what makes an order block is the context surrounding it. So order blocks do not stand alone. They do not stand alone. We can reference my notes from the 2024 mentorship, and we can see that an order block is validated when you have other factors around the idea that the market should turn. So it doesn't stand alone. There has to be context around it. There has to be context around it. Now in this case, in this trade, this is the 50-minute gap that I'm trying to frame a reversal off of, right? Do these up candles, does this buy side delivery here, does that really indicate that the market's rejecting this gap? Not at all. It may be closing within on the 5-minute time frame, but if we look at the 1-minute, these gaps are literally coloring well outside the lines of that 15-minute gap. That does not tell me that it's going to reverse there. Therefore, this is not a bearish order block. So this is never a valid trade. Now I know this after doing some study. This is a valid bearish order block. Even though the mean threshold of it is violated, I'm still considering this as a valid bearish order block. Because, number one, it removes liquidity from the marketplace, right? We have a run on all the buy stops here. Takes out this short-term high right here as well. And it indicates respect of a premium array. Indicates the respect of a premium array because it trades up into it but closed below it. That's a sign of weakness. So it removes liquidity from the marketplace, trades up into the premium array and closed below it. That is a valid bearish order block for me. So once down candles come in, overlap the open price of that, that becomes a valid bearish order block. Now at this point in time, I stopped out on a sell already, so I'm really lacking conviction in the idea of lower prices. If I go to my live trading notes, this is from Friday, wrong day. So if we go to live trading notes, we can see that there's nothing I have confidence in. Stopping out in that short after I knew price was bullish is definitely affecting me as I no longer have any conviction in the sell idea. So right then and there at 10:10, we can see that I don't have conviction in the sell idea. I don't like how this is dropping in high resistance fashion, though it has rebalanced the overnight impulse, so again, failed to trade to consequent encroachment of the hourly sell-side imbalance, buy-side and deficiency. I'm not liking this drop. Ideally, it makes a higher high and fails, but the volatility is left and it's getting later in the AM session. So at this point, I'm thinking I should probably just walk away for a small red day. But that's usually not how things go, right? Whenever you know you need to do something, you tend to do the opposite and you end up paying the price. So I'm not able to trust this as a valid bearish order block because, number one, I stopped out on this idea here, and number two, something that may be flawed about my trading model is the fixed 16-point stop loss. Now I know that all solid winning setups typically don't put me in any kind of drawdown over 12 handles, 12 to 16 handles. That's why I have the max drawdown at 16 handles. But I do have one winning trade where I was in drawdown of over 19 handles before it actually played out. And there's been multiple setups where the market has knocked me out using a stop loss of under 20 handles before that trade actually delivers. And it's been on trades where I executed off the order block. So one thing about the order block is that I may have to risk more or not execute at the low of that candle, maybe closer towards the mean threshold of it, especially if the market is lacking volatility and the volatility is kind of dying down. But I'm not expecting precision. I'm not expecting really fast delivery. Then maybe I can enter off of the sensitive point of the order block inside of it, maybe even at the midpoint, to frame a risk that makes sense. But this one candle's range is 50 handles. So if I'm selling short here and I want to stop loss at that candle's high, I'm risking 55 points, which is something that I've never done before. So in order for this trade to even work, I would literally have to buy or sell like the midpoint, the mean threshold of that candle, just for the stop to even be 27 handles. So it just doesn't make sense. The risk for me just did not make sense framing it off of this candle. If I would have used my max risk threshold of 16 points, I'm not giving it any room to refer to that last up close candle at all. I'm only giving it this much breathing room to trade up into there. So therefore I don't take it. Now when the market forms another swing point right here, and now I have a short-term high, intermediate-term high, and a short-term high, I was anticipating this would be an intermediate-term high because we formed a short-term high right here, large down candle, took these up candles, close over them, and then again I sell short at the market there. So another impulsive sell short there. That was not a terrible idea. This was not a good idea because this was at the wrong location, and that is not a bearish order block because it does not show me indication of respect of that 15-minute sell side imbalance and buy side inefficiency. You can see the difference between the up candles that actually do reject price and the ones that don't. This one does. Why? Because it removes liquidity from the marketplace, takes out this short-term high, also takes out these highs back here, closes below that gap. This right here does what? It doesn't really do anything. It just trades up, okay? Does not indicate that it's respecting this gap at all. Does not remove any liquidity from the marketplace. In fact, I think it makes highs equal, like that. Look at that, see? So it's trading up to that high, but it's not taking it. Therefore, if the market turns away from this, there's a reason for it to go back there, which means my stop loss would be in jeopardy, which means it's not a good trade. So another thing that I've noted about high probability order blocks, what does not make an order block? It leaves behind a smooth edge or a reason for price to break its extreme. In this case, it trades up to that high, but it does not take it, meaning it left a smooth edge in price, and there's a reason for it to take its extreme, which would be the high. So that is not an order block. That is not what I want to see for an order block. This is. Does this leave a smooth edge? No, it doesn't, because it drives above this candle's high. So above, it is jagged, and below, we can target these smooth lows here. So I didn't have to be right about the direction of the daily candle. In essence, I was still correct because the market offered a sell setup only after it delivered the premium. So I wasn't really trusting of this because I stopped out here and because the risk to me just did not make sense. Although the risk here, I didn't even really think about it because I impulsively jumped in the market short. So I didn't really have a chance to think about it. So moving forward, I am not even putting market orders on my platform on Top Step X. I'm not even doing it. So if I, let's see, where are they? Oh, it's in here. So hide, buy, and sell buttons. I'm not even going to have this out anymore because I know how I am. I'm going to hide them. I'm just going to completely remove them. I'm not executing. Oh, shoot. I thought I just clicked an entry. I'm not executing at the market at all. Done. I'm done with it. So today's a small red day, but it literally doesn't matter. Like I'm completely unbothered and unaffected because I know it can come to tomorrow. Tomorrow can make a whole lot of sense. And I can have a good trading day tomorrow, just literally doing the same thing that I did today, but also learning from the mistakes that I made today. Now I know going into tomorrow what makes a high probability order block. Now I'm establishing market criteria that I have to follow in order for me to put risk on. It either has to remove liquidity from the marketplace, or it has to indicate respect of a PD array. So now I should go into the next day hunting those things to confirm an idea. And that is what's going to tighten down the way that I get into a trade, because that is one of the biggest killers last month. going back to TradeZella, going back to reports, going back to tags. These two mistakes are basically trades where I don't have confirmation to get into the market at all, but I'm getting into the market. That's 8 times. That's 8 trades last month where I made that mistake. So I'm going to directly address that this month by focusing on one mode of getting into a trade, which is just going to be the change in the state of delivery. I'm just going to focus on that. I will still take obvious gaps, obvious fair value gaps, if the market presents them. I'm not going to see them and completely ignore them and be like, I can't use that to get into a trade because it's not my entry model. Most of the time, they're paired with an order block anyways. I do have solid setups off of obvious fair value gaps, but in this case, change in the state of delivery is all I want to focus on. That's it. That's what I'm going to be working on moving forward this month. I'm going to keep studying. I'm going to keep backtesting. My backtesting results are very, very good. So I know that the model is profitable. I know that the model works. I go to the dashboard, like backtesting results in 2022 so far. And I've only tested 2 weeks of November, October, and 2.5 weeks of September. And this is the results. So these are the statistics that I'm kind of looking at right here, right? It's a low strike rate, but high R model. Look at the average win to loss, 6.38 to 1. My day win percentage is rise in backtesting, which is good. The trade win is up slightly. So if we compare this to the results that I actually have right now, we can see what's lacking. Well, it's going to be trade win and day win. But my average win to loss is still hanging in there. So we can see that I simply need to take more quality setups. How can I take more quality setups? Well, I need to tighten down the criteria that I'm using to get into a trade and to actually put risk on. I think that's going to be a substantial change that will help me and help my performance, increase that win rate, increase the day win percentage. But I do expect to take a little bit of drawdown in the beginning, just get used of that way of putting risk on. Because I've been trading order blocks, but not in a sense where I'm just solely focused on that, which is good because now I've established specific criteria for me to use an order block. An order block is only an order block when it removes liquidity from the marketplace or refers to a PD array and indicates respect of that. That's it. Meaning if it doesn't do that, it's not an order block and I'm not going to take it. That's it. And I know what is not an order block. An order block does not stand alone. It has to do one of those two things that I just mentioned, and it does not leave a smooth edge in price. If it leaves a smooth edge in price, there's a reason to take its extreme, meaning that's not a trade that I want to take because there's a reason for the market to take my stop loss. My stop loss is going to be in jeopardy. So it's going to be it for this one. It's a quick review. I feel like when I make these videos longer, like over half an hour, I get less views on them. So I'm going to just keep putting it within the 20-minute range to do a quick little review. I could literally sit here and talk for like 2 hours about my trading, my performance, and everything that I'm doing to get better and all the work that I'm putting in. But just know that right now, all I'm doing is back testing, applying my knowledge of higher time frame narratives. So I'm practicing higher time frame narrative and executing the change in the state of delivery. Those are the two changes that I'm focused on making right now, and I think will improve my win percentage. So that's it for this one. Talk to you tomorrow.